Hello, clients and friends. This is David Ware from Ware Financial, and it's my pleasure to welcome you to our 2025 Quarter 4 Economic Review. 2025 marked the third consecutive year in which equities delivered double-digit returns. This extended bull market was powered largely by 3 federal rate cuts during the second half of the year, robust AI-driven technology earnings, and broadly positive investor sentiment. During the fourth quarter, investors continued to see new highs in major U.S. equity markets. The S&P 500 gained 2.4% in the fourth quarter, closing 2025 at 6,845. That's nearly 16% for the year. The Dow Jones up 4.5% for the quarter at 48,063. That's up almost 13%. During the fourth quarter, inflation continued to show incremental signs of easing, while economic growth remained resilient, contributing to an environment described as the Goldilocks scenario. This balancing of moderate inflation and steady growth helped maintain investor confidence throughout the quarter. The November core CPI, which does not include food and energy prices, was cooler than anticipated by analysts, increasing 2.6% over the past 12 months. Interest rates were lower twice during the quarter for a total of 50 basis points in the fourth quarter, ending at 3.5 to 3.75%. Including the September rate cut, 2025 brought a total of 3 consecutive rate cuts. The Federal Open Market Committee ended the year forecasting future rate cuts in 2026. However, they indicated they could come at a slower pace than we experienced in the last half of 2025. The fourth quarter of 2025 was relatively calm for the bond market. As the quarter ended, the 10-year Treasury 4.18%, the 5-year Treasury 3.7%, and the 30-year Treasury 4.84%. Bond behavior continues to hinge on the direction of interest rates. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, expectations of slower easing or persistent inflation pressures could push yields higher. Bonds can be an integral part of a well-diversified portfolio and usually offer stability during times of market decline. However, please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against a loss. Safety comes with a cost, and major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on December 29, 2025 was 0.52%, and the average 12-month CD rate was 1.9%. For anyone who is interested in exploring better sources of interest rates, please contact our office. Looking towards 2026, most strategists expect the bull market to continue. Analysts are optimistic about 2026, with a consensus that year-end returns will be positive. However, investors are aware that market pullbacks occur on average every 18 months, so we must remain prepared. 2026 is also a midterm election year, and this has historically created increased uncertainty as investors assess potential changes in congressional control and their implication for taxes, spending, and regulation. While investors are optimistic, market volatility is likely to persist. This makes discipline and perspective essential. If 2025 taught us anything, it's that during challenging times, it's best to avoid emotional decisions. Although history is not a forecast of future outcomes, in 2025, equity markets had a huge downturn in the first half of the year. But by year end, they rewarded investors who demonstrated patience and discipline during tough times. We want to remind listeners that we encourage long-term investing. If you examine a 45-year chart of equity returns, we are once again reminded that over a 40, 30, or 20-year time frame, even with some very severe downturns, historically long-term investors have been rewarded. In summary, equities continued to reach record highs in the fourth quarter. The rally was primarily fueled by additional monetary policy easing, the AI boom, a resilient labor market, and consistently strong corporate earnings. In the fourth quarter, the Fed reduced the federal funds rate twice by a total of 50 basis points. finishing the year at a range of 3.5 to 3.75%, with the potential for additional but slower cuts next year. Inflation numbers came in better than expected, and the consumer price index rose less than expected. We enter 2026 with optimism, but we always need to be prepared for a pullback. So overall, investor sentiment was healthy and upbeat in the fourth quarter. In conclusion, while we are optimistic, we will continue to monitor potential disruptors, including a slowing economy, the effects of new tax legislation, the path of inflation and interest rates, and heightened geopolitical uncertainty. Focusing on your long-term goals and staying the course of a well-guided plan can help you stay grounded and confident during these times of uncertainty. We are here for you. Please reach out with any questions or concerns. Your financial well-being is always our priority. As your financial stewards, we closely monitor areas that we believe are important to your financial well-being. We will keep you updated on developments that could impact your personal situation. Once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel comfortable sharing this update with anyone else you think can benefit from it. Thanks again.